Now speaking, Brian Moynihan, Chief Executive Officer. Bank of America reported one of the best quarters and first half of net income in its history. Earnings per share grew 21% over the second quarter of 2022, and all business segments performed well. The company saw strong organic growth and operating leverage, with customer spending patterns now more consistent with the pre-pandemic lower growth, lower inflation economy. In consumer banking, Bank of America opened 157,000 net new checking accounts, 1 million plus credit card accounts, and 10% more investment accounts year over year. Global Wealth added 12,000 net new relationships in Merrill and Private Bank, and Advisors opened more than 36,000 new banking relationships in the quarter. Global Banking added 1,000 new commercial and business banking clients across the U.S., and Global Markets had one of the highest second quarters for sales and trading in its history. Digital engagement is also strong, with 46 million active users logging over 1 billion times a month, and Erica and Zelle both seeing strong growth. Bank of America has achieved 8 straight quarters of operating leverage, and Alistair will discuss the company's expectations for the rest of 2023. Now speaking, Alistair Borthwick, Chief Financial Officer. And second, the mix of securities has shifted to longer-dated securities, which have higher yields. So, in total, the yield on cash and securities was 1.3% at the end of the quarter. And that's up from 1.1% at the end of the first quarter. In the second quarter, the company generated $7.4 billion in net income and 88 cents per diluted share. Revenue grew 11%, driven by a 14% improvement in net interest income and a 10% increase in sales and trading results ex-DVA. There were some headwinds, including lower service charges from higher earnings credit rates on deposits for commercial clients and policy changes to lower insufficient funding overdraft fees for consumer customers, as well as lower asset management and brokerage fees due to lower equity and fixed income market levels and market uncertainty. There was also a net DVA loss of $102 million and securities losses of $200 million. The tax rate benefited from ESG investments, but was offset by operating losses on the ESG investments. Expenses included $276 million in litigation expense. Asset quality remains solid, with a charge-off rate of 33 basis points, which is only 1 basis point higher than the first quarter and still below the 39 basis points seen in Q4 of 2019. The balance sheet ended the quarter at $3.1 trillion, declining $72 billion from the first quarter. Cash levels remained high at $374 billion, and loans grew $5 billion. Liquidity remained strong at $867 billion, and shareholders' equity increased $3 billion. Returns were 15.5% return on tangible common equity and 94 basis points return on assets. Average loans grew 3% year over year, driven by consumer credit card growth and a 4% increase in commercial loans. Total deposits declined 1.7%, with more than $1 trillion in high-quality consumer deposits remaining $274 billion above pre-pandemic levels. The average deposit rate paid rose to 22 basis points, and the supplemental leverage ratio was 6%. The Tier 1 ratio remains comfortably above requirements. RBC Capital Markets analyst Gerard Cassidy inquired, "Brian, what is your view on the likelihood of capital ratios increasing for large banks, as proposed by Vice Chair Barr? Additionally, what are your thoughts on the potential increase in capital requirements for holding residential mortgages?" Brian Moynihan replied, "The capital industry is sufficient and Basel III rules will be released soon. We have an 11.6% CET1 ratio, which is above the current requirement of 10.4%. It's important to maintain global competitive parity, but we must also be mindful of the potential downside of these rules. A 10% increase in our capital levels could mean a loss of $150 billion in loans at the margin, which could slow down the economy. We need our banks to support the economy, so all of this must be balanced out when adopting these rules." RBC Capital Markets analyst Gerard Cassidy inquired, "Alistair, what factors would lead to a change in the balance sheet position and what is the outlook for balance sheet management?" Alistair Borthwick replied, "Gerard, our approach to interest rate risk has been one of balance. We work to maintain a narrower corridor of risk over time, with both upside and downside potential. Our goal is to sustain NII at a higher level for longer. Going forward, we don't anticipate major changes to our philosophy, but rather, we'll be making minor tweaks. Ultimately, our success will depend on normalizing deposits and loan growth." Evercore IC analyst Glenn Schorr inquired, "Can you explain the 5% increase in expenses and how it relates to revenue growth?" Brian Moynihan replied, "Glenn, our goal is to grow revenue faster than expenses. We've been doing this for many decades and have seen success in our data. We are continuing to engineer our business by applying technology to reduce transactional activity and offsetting that with increased investments in our wealth management business. We expect to manage expenses in line with revenue growth, with expenses growing at a rate lower than the revenue growth rate. We anticipate this trend to continue into 2024 and beyond. Alistair Borthwick replied, Glenn, we saw 16.2 in the first quarter and 16 this quarter. We've made headcount adjustments to position us well for the next quarter, and we anticipate 15.8. We expect to end the year at 15.6, which is comparable to Q4 of last year's 15.5. This flat trajectory in an inflationary environment is a good way to set up for next year. Wells Fargo Securities analyst Mike Mayo inquired, how long do you expect the 8 consecutive quarters of positive operating leverage to last? To what degree do your digital efforts play a part in sustaining this positive operating leverage through 2024 and 2025? Brian Moynihan replied, our goal is to maintain operating leverage. We experienced a challenging time when interest rates shifted at the end of 2019, but we quickly recovered. When asked a few years ago if NE would be used to increase the bottom line, we have achieved that goal with over 80% of it falling to the bottom line. We provided specific expense guidance by quarter and expect to see operating leverage. As the economy stabilizes, we anticipate deposits and loan growth. We have managed headcount down, even with a reduced turnover rate. This sets us up for the second half of the year as the headcount benefit has not yet been reflected in the P&L and will offset some inflation. Wells Fargo Securities analyst Mike Mayo inquired, what gives you more confidence on the NE and deposit stabilization fronts? Alistair Borthwick replied, Mike, our client base has been in a privileged and advantaged position over the past year and a half. We've seen extraordinary resilience in the global banking sector. Q2 was tax season, so deposits were down $9 billion, but tax payments of $14 to $16 billion were made. We're seeing some stability, and our focus on transactional primary operating may be paying off. On page 12 of the earnings deck, we show the Fed's engineering across the board and how we're reacting to our customer base. Seaport Global Securities analyst Jim Mitchell inquired, what is your outlook on deposit mix going forward, given the decrease in NIDs and increase in CD demand? Brian Moynihan replied, the deposit mix across customer segments is a key factor in our cost of deposits. Page 12 shows that we have excess transactional cash, which is largely low interest or no interest checking accounts. This cash far exceeds our loan balances and provides a cushion for consumers to pay bills and unexpected expenses. This has resulted in a cost of deposits of 1.24, which is lower than what other companies have. We have also seen an increase in average checking account balances from pre-pandemic levels of $11,000 to $10,000, and now to around $600, $500. This dynamic is driven by the mix of interest-bearing and non-interest-bearing accounts, which is detailed on page 13. Consumers now have more money available, which has provided a great opportunity for us. Seaport Global Securities analyst Jim Mitchell inquired, have the mix shifts stabilized? Brian Moynihan replied, the data on page 12 of our quarterly report shows that our customer base and lines of business are stable. Our Global Wealth and Investment Management, GWIM, and Global Banking segments have a very stable average balance movement. Half of this is due to excess balance and half is due to earnings credit rate through the GTS process. In consumer banking, the average balance moves between $980 billion and $1 trillion depending on the week, and payrolls can cause it to exceed $1 trillion. This provides us with an advantage in pricing of around 20 basis points. We have $40 billion in certificates of deposit, CDs, but this is not our core business. We also push wealth management flows and consumer investment flows, which move excess cash into the market. Oppenheimer and Company analyst Chris Katofsky inquired, can you explain how customer accounts were opened without consent and how this differs from the Wells Fargo scandal? Brian Moynihan replied, Chris, when we underwent a thorough review by the OCC, we changed our practices and addressed a small number of accounts from that time period. The other agencies did not take any action, so the Consumer Bureau had to step in. We have now resolved this issue this quarter. Brian Moynihan replied, the accounts in question reflect data up to the current time, but the accounts themselves date back to 2016 and prior. In 2017, the Comptroller of the Currency, Curry, conducted a 3-phase review of all other firms and found no issues. This was further confirmed when the next comptroller testified in Congress during the Obama administration after Wells Fargo, and into the early part of the Trump administration with Comptroller Otting. We made the necessary changes to our processes at that time. Morgan Stanley analyst Betsy Grisek inquired, could you please explain how you are achieving positive operating leverage despite increasing investment spend in your core platforms? Brian Moynihan replied, in response to your question, Betsy, the number of branches has decreased from 3,900 to 3,800 over the last year. We've implemented operational efficiencies such as digital transactions, which have replaced manual processes like check processing. We've also used artificial intelligence to help our business bankers become more efficient in their outreach and to match clients with advisors. These changes have resulted in a significant cost savings and have allowed us to reinvest in our branches and increase deposits. Morgan Stanley analyst Betsy Grisek inquired, is it fair to say that you anticipate more growth in AI going forward? Brian Moynihan replied, we began developing a natural language processing capability 8 years ago to answer questions and ensure the accuracy of the response. This algorithm anticipates the answer to the question, drawing from our data and looking into customer accounts. During the last quarter, 165 million interactions were handled through Erica, such as emails, texts, and phone calls. We are continuing to expand the functionality of Erica, but it is important to carefully control the application of new programs that hallucinate and other advanced techniques. We also use Erica in controlled settings for drafting CO credit offer memoranda and business targeting. As we better understand how Erica works, we can build an attribution and accountability. Morgan Stanley analyst Betsy Grisek inquired, what are your expectations for buybacks given the review of the SCB with the Fed? Alistair Borthwick replied, we got the final stress capital buffer in August, and we'll have to wait for Basel III final clarity before we get full perspective. We have plenty of capital and have been buying back enough shares to offset share dilution. We've had 110 basis points over the past year and kept return on tangible common equity around 15.5% while buying back shares, so we have the flexibility to do a little bit of everything. We want to see what the final rules look like before making any decisions. Jefferies analyst Ken Usdin inquired, what is your view on the ongoing normalization of card losses and anything else we should be mindful of when thinking about credit normalization? Alistair Borthwick replied, Ken, our charge-offs remain well below pandemic levels. This is indicative of the consumer's resilience, which is evident in the unemployment statistics and increased spending year over year. We have seen consistent results in this regard, and we are benefiting from the card experience. Jefferies analyst Ken Usdin inquired, can you provide an update on the effect of service charge changes and new rewards card benefits? Are we close to seeing stability in these areas? Brian Moynihan replied, our company has seen a 10-year shift in how we manage overdraft fees. Last year, we implemented a set of changes that are now fully integrated into our system. This quarter, we saw a slight increase due to pre-final changes. According to FDIC data, our overdraft fees are now around $30 million per quarter, which is significantly lower than other companies. All the changes required by recent announcements have been completed and are now part of our run rate. Portales Partners analyst Charles Peabody inquired, what was the thinking behind the increase in interest-bearing deposits with the Fed, despite a relatively flat deposit base? Alistair Borthwick replied, Charles, at the end of last quarter, we made a strategic decision to build cash reserves due to the extraordinary circumstances in the industry. As the environment is normalizing, our cash levels are decreasing as expected. Portales Partners analyst Charles Peabody inquired, would RWA shrinking help your capital? Alistair Borthwick replied, the increase in cash balances shouldn't have a significant impact on RWAs, but it could affect our net interest yield. This is because the denominator of the equation is increased, which temporarily inflates the balance sheet. As we return to normal operations, we expect to see the numerator and denominator of the equation reduce, resulting in a smaller, more efficient balance sheet and no negative effect on NII. UBS analyst Erica Najarian inquired, Alistair, given the current environment, what is the expected net interest income trajectory for next year and how does the $14 billion run rate capture the cumulative deposit beta? Alistair Borthwick replied, our asset disclosures reflect the betas that we believe at the time. We are currently providing guidance for the rest of the year, and the forward curve suggests 1 or 2 hikes this year and up to 5 declines next year. We need to take the next 3 to 6 months to determine our outlook for 2024. UBS analyst Erica Najarian inquired, can you provide an update on the impact of the 100 basis point drop in interest rates on your securities book, and how much of that is attributed to short versus long rates? Alistair Borthwick replied, our total assets are down $3.6 billion this quarter. The majority of that decrease is in the short end, and we believe that our securities book and the large rotation into interest-bearing have helped to stabilize our position. As rates continue to decline, we are better insulated from the effects than we were 2 years ago when we had less interest-bearing assets. Wells Fargo securities analyst Mike Mayo inquired, given the digital progress you've made, why haven't you been able to reduce your efficiency ratio to levels seen in 2018 and 2019, 57 to 58%? How long would it take to reach those levels? Brian Moynihan replied, Mike, our 8.5-year track record of operating leverage is a testament to our commitment to digital transformation and efficiency. We've reduced our branch count and improved our efficiency ratio, which is largely driven by our wealth management business. Our revenue takeout for advisor compensation is high, but we're continuing to make improvements to increase efficiency. Net interest income has also become a more important part of our business, helping to push the efficiency ratio down. We're dedicated to applying technology across the board to reduce work and bring it to the bottom line, and making the necessary investments to keep it that way. Our efficiency ratio is best in class when you look at each line of business. Wells Fargo securities analyst Mike Mayo Inquired, what savings and expenses can be expected from Erica and Bank of America AI over the next few years? Brian Moynihan replied, we've seen a 10% increase in customers doing core checking with us since 2019, resulting in 3 million more customers doing 20 to 30 transactions a month. We've managed to keep our expenses relatively flat while absorbing inflation and wage increases. Our cost of deposits as a percentage of deposits remains competitive, and we continue to drive it down. We've reduced headcount in our operations group and invested in technology and developers, resulting in a more efficient business. We expect this trend to continue to benefit us. Brian Moynihan replied, thank you for joining us. We had a strong quarter with profitability and 15% return on tangible common equity or better, driving organic growth and operating leverage. We provided clarity on future expenses and NE. Our capital markets and investment banking performance were strong, along with our other usual great performances. We feel confident in the company's position going forward.